We are back with our next video on chapter 12. We're still looking at different type of adjusting entries that are made at the end of the accounting period under the accrual accounting system. Next up, adjustment for depreciation. When you think about your property, plant, and equipment assets, these are long-term assets that are used in operation of a business in order to earn revenue for that business organization. These assets go through a process known as depreciation. Again, we're saying, what is depreciation? It is a process of allocating the cost of these long-term assets and expensing that cost over the asset's useful life, meaning that a portion of the asset's cost, sometimes all of the cost of an asset, will become an expense over time through this process known as depreciation. For example, we bought equipment for $30,000 on the 1st of January. The equipment has a salvage value of $4,000 with a useful life of 5 years. Remember, salvage value is the estimated selling price of the asset at the end of the asset's useful life. So we're saying at the end of 5 years, the equipment should be worth about $4,000. So the question is, based upon this information, what would be the amount of the annual depreciation expense recognized on December 31st? So we have a method for recording depreciation. It is called straight line depreciation, and it has a formula. That formula is cost minus salvage value divided by the asset's estimated useful life. We're going to plug these numbers into this formula to determine how much of the cost of the equipment we're going to expense or depreciate each year. So you ready? Let's go. So the cost is $30,000 minus $4,000 being the salvage. That would give us $26,000. Divide that by the useful life of 5 years. The amount is $5,200. That means that every year for the next 5 years, we're going to make an adjusting entry for depreciation. You would debit the expense account for the $5,200, credit the contra asset account known as accumulated depreciation, $5,200. So you would make this same adjusting entry every year over the next 5 years. Next up, we look at what's known as accrued expenses. Accrued expenses. These are expenses that have already incurred but have not been paid nor recorded. Again, expenses that have already incurred, taken place, but they have not yet been recorded nor have they been paid. We'll look at different types of accrued expenses such as accrued salaries, accrued payroll taxes, accrued interest on a notes payable account. So we covered the accrued salaries back in chapter 10, where you would debit account titles such as salary expense, credit the liability account such as salaries payable. So once again, we covered this concept back in chapter 10 for its accrued salaries. In chapter 11, we covered accrued payroll taxes. With the accrued payroll taxes, these shows the taxes that are owed by the employer at the end of each pay period. So we talked about the different type of taxes owed by the employer, such as Social Security taxes and such as Medicare tax. So you would multiply the taxable earnings times the applicable tax rate. So in this case, the Social Security tax rate is 6.2%. The Medicare tax rate is 1.45%. So you multiply the taxable earnings times the applicable tax rate to determine the amount of taxes owed by the employer. So in this situation, the amount of taxes owed would equal $91.80. To record this transaction in your journal, you would debit payroll tax expense for the $91.80, the total amount of taxes owed by the employer, then credit Social Security tax payable and Medicare tax payable. Because at this point, the taxes have not yet been paid. Because we still owe for the taxes, you're going to recognize your payable count. So next, we're going to take a look at accrued unemployment taxes. So again, remember that unemployment taxes are taxes that you're going to pay for unemployment tax insurance for your employees. So again, the rates will be given for the unemployment taxes for both federal unemployment taxes as well as for state unemployment taxes. So you're going to multiply the applicable wages times the appropriate tax rate to get the amount of taxes owed for unemployment. Now recall that any taxes that are owed by the employer, we would debit account title known as payroll tax expense. So in this case, the total amount of tax owed by the employer total even $72. So to record this transaction, we would debit payroll tax expense for the $72, credit federal unemployment tax payable for $7.20, credit state unemployment tax payable for $64.80. So whenever you have an accrued expense transaction, you will always debit an expense account and you're going to always credit a payable account. So we covered these taxes back in chapter 11. So now it's time for something new. Accrued interest on a notes payable account. So we're saying, what is a notes payable? A notes payable is a promissory note. It is an agreement to pay back the amount that's owed plus interest at some point in time in the future. So for our next example, Whiteside Antiques issued a 2-month note for $2,000 with an annual interest of 12%. That means that this company owes someone $2,000. They signed the note on December the 1st. They must pay the note back in 2 months, and they're paying interest of 12% on this actual note. Okay? The actual note plus the accrued interest will become due on February 1st of 2020. Now, the interest has to be calculated. We must show the amount of interest that is owed on this note by the end of our accounting period. Our accounting period is going to end on December 31st. So remember back to your math courses and the interest formula. Interest equals principal times rate times time. The principal amount would be $2,000. The rate would be 12%, and our time factor is 1 over 12. That's because the 12% is the annual interest rate. That's the rate for an entire year. In this case, the loan is only outstanding for the month of December, so our time factor is 1 over 12. So the accrued interest on this note would equal $20. To record this adjustment at the end of the accounting period, you would debit interest expense, in this case for the $20, credit interest payable for $20. Again, debit interest expense for $20, credit interest payable for the $20. Okay? We'll look at one other type of adjustment, then we'll continue with one more video. Prepaid expenses, or expenses paid for in advance. Again, prepaid expenses refer to expenses paid for in advance. So prepaid expenses are also referred to as being assets. Example would be prepaid supplies, prepaid insurance, prepaid interest on a notes payable account. Let's go to the example of how to account for prepaid interest on a notes payable account. So you ready? December 1st, Jim's Java joint borrowed from the bank $50,000 in order to expand operations. The firm issued a 4-month 6% note for $50,000 to the bank and received $49,000 in cash because the bank deducted the interest for the entire period in advance. In journal form, show the entry that will be made to record this transaction and the adjustment for a prepaid interest that should be recorded on December 31st, 2019. So we're going to make two journal entries, one on December 1st to record the initial transaction, then on December 31st to show the adjustment we're going to make at the end of the year. Okay? So to record the initial transaction, we'll debit cash $49,000, the amount of cash received. We're going to recognize prepaid interest for $1,000 and credit the notes payable account for $50,000. So maybe you're saying, how do they come up with the prepaid interest amount? Well, interest again is principal times rate times time. So the interest will be $50,000 times 0.06 times 4 over 12. That gave us $1,000 in prepaid interest. Now, at the end of the year, we would either recognize how much of the prepaid interest has now become an expense. So the prepaid interest covers a 4-month time period, which means the interest expense will be $250 per month. And from December 1st to the 31st is a 1-month time period. So when you make the adjustment, we're going to debit interest expense for the $250, credit the asset account prepaid interest for $250. Okay? So study the adjustment we've covered so far. We're going to come back with two last topics: how to account for accrued income adjustments and what's known as deferred income adjustments. Stay tuned for part 3.